Some of my in-the-money covered calls are breaking my heart. We had good times for a while, but now it's time to start thinking about breaking up and moving on. In this episode, I'll have a few bad, annoying similes and puns about covered calls and relationships, but I'll also explain exactly when you should start thinking about closing out your in-the-money covered calls and when you should absolutely break up with them. A lot of relationship and option decisions must be made with your judgment and opinion. But getting out of in-the-money covered calls is pretty clear-cut and can be mostly data-driven. The data will be the annualized yield on your covered calls remaining time value versus the short-term rate you can get on your cash or the rate you think you can get on other investment opportunities. As an investor, you need to know where you get your edge. What gives you the confidence that you'll make money in the market over the long term? Why will you make more money in the market than just putting all your money in CDs? Or if you're very good, how will you beat the returns on popular indices like the S&P 500? Some people have or believe they have edges in the following: technical analysis and charting, momentum trading, investing in areas of the market you know well. I'm on board with this one. Putting more weight on certain types of stocks like dividends, growth, or value, undervalued or hot sectors. I like to take a close look at beaten up sectors of the market. Superior management of options using strategies like the wheel or spreads, iron condors, strangles, and straddles, all depending on the circumstance. I prefer to keep it simple, just selling puts and calls. I believe my edges are finding outstanding undervalued stocks in companies I understand. Then having the patience to let the market eventually value them correctly or even overvalue them. And finally, earning some option premium while this happens. That's what this channel is all about. Please let me know your edges in the comments. Back to in-the-money covered calls. Pulte Homes is one of my exes that I've spoken about in previous episodes. Those episodes are linked in the description. My covered calls on PHM went deep in the money and I eventually moved on once it made sense to do so. Now me and Capital One, COF, are on the outs and could be breaking up soon. My Roblox covered call is also in the money, but this relationship still has hope and we might be able to repair our problems and make up. We'll go over my current situations with COF and Roblox in this episode, and I'll show you how I make my decisions on them. We'll talk about the specifics of this chart in a minute, but for now, some context on our scenario. Imagine you have a covered call that's gone in the money, maybe way in the money. This means the price of the stock has gone above your strike price, maybe way above your strike price, and there's still quite a bit of time left until it expires, maybe several weeks or months. You've decided you don't want to roll up and out. See my episode on rolling if you're not sure what that means. It's linked in the description. You also think the stock is getting a little frothy. If it's gone above your strike price and you don't want to roll up and out, it probably means the stock is above your estimate of its fair value. So you're ready to sell and invest those funds in another opportunity. Don't forget about considering the tax consequences. You'll be realizing a loss on your covered call and probably a gain on the underlying stock. So what should you do? Should you just wait it out and let it get called away at expiration? Or when does it make sense to save a little bit of this time, pay some time value, close the option out early, sell the stock, and reinvest in a better opportunity? The answer to this is one of the few things in options that is clear and straightforward, but maybe not so clear for investors just getting started with options. You'll need to understand time value and how to compute it, and how to compute annualized yield for this time value. Once you have this number, the time value annualized yield, you can be confident you have the main piece of information you need to make a good decision. I'll show you how to do this with a couple of examples. Once you've computed this yield, it'll be time to make a decision, and you can either be aggressive or conservative with your decision. I'll explain each. Here's how to be aggressive when breaking up with your covered call. Once you've found another investment opportunity that you think will earn an annual rate greater than the annualized yield of the remaining time value on your current covered call, then it's time to close out and redeploy these funds to your new investment. But don't be too quick to do this. Warren Buffett has a famous quote about there being no called strikes in investing. Here's an article about that linked in the description. You don't need to obsess about FOMO, fear of missing out. You can and probably should be very careful and patiently wait for very good investment opportunities, especially when you're getting a respectable return on your covered calls time value. So if there's no other investment opportunity that you're excited about, there's another safer criteria you can use for moving on from your in-the-money covered calls. And that is short-term rates on cash. Here's a page that shows some of the highest yielding CDs. It's linked in the description. Your broker where you sell your options will probably have some choices for you. Some brokers offer high-yielding cash accounts that can be used for securing your short puts. When the annualized yield for the remaining time value falls below the short-term rates for CDs or treasuries, you should probably go ahead and close those out and move the funds into a better investment opportunity or a cash equivalent that is earning something close to the short-term rate. As of January 13, 2024, this is currently just above 5%. I like to subtract an additional 1% off the current rate to cover transaction and spread costs. So currently I'll start being really motivated to close out my in-the-money covered calls when their time value yield drops to 4% or lower. But that will fluctuate with the short-term rates. Again, this is because you can close out your option and sell your stock and then drop all those proceeds into a short-term CD or treasury and earn a better return than just leaving it in your covered call, an underlying stock. You'll also get rid of the small risk of your stock doing a major nosedive, and you've got no more upside on the underlying stock because of the call. The only remaining upside is the further decay of your time value. There is one other consideration, delta. Recall that delta is an approximation of the probability your option will finish in the money. However, the delta for your in-the-money covered calls that have a time value annualized yield low enough to consider closing will typically be so high that it's not worth considering. In other words, these in-the-money covered calls will almost certainly finish in the money. If you'd like to know more about delta, see my episode on delta, linked in the description. As promised, let's look at a couple of my currently active covered calls that are in the money. I monitor their time value annualized yield daily in this column to see if it makes sense to break up with them and move on, to put the capital to work elsewhere. We'll look at how to compute your call's intrinsic and time value, and then how to compute the annualized yield on that time value. But first, if you're enjoying this content, please consider liking and subscribing. I want to thank the 413 subscribers to this channel so far. I've got a long-term goal of getting to 1,000. I currently only have one in-the-money covered call that has a TVAY low enough to consider closing, Capital One Financial. I have a couple others, Meta and Roblox, that are in the money but still have TVAYs above 10%, so I can happily sit back and earn that for now. Let's go over COF first, and then we'll take a look at my Roblox in-the-money covered call. I'll pick out the important things we need to compute these values so it's easier to follow. Some historical context first on COF. I sold a put here around November 15th at a $100 strike and got assigned somewhere in here. Since then I've been selling covered calls, and with dividends and premiums have my cost basis down to 82.86. COF has been getting some Buffett bumps during this time as news came out that Berkshire Hathaway took a position in Capital One, and COF has benefited from the market believing we'll have a soft landing, to be determined. If I wait around until June, my current in-the-money covered call will most likely get called away at $100 per share. I'll make a profit of $17 per share, but I probably won't wait that long. I'm going to zoom in on a chart and show my calculations for why I probably won't wait for expiration, unless COF starts falling closer to its strike price. Here's the chart we looked at earlier with some calculations for time value annualized yield, TVAY for short. The first thing to note is how to compute the covered call's intrinsic value. You take the current value of the underlying stock, here 127, and subtract the strike price, here 100. This leaves you with the amount the contract holder would make per share if she executed that option right now, 27.7. That's the option's current intrinsic value. We can use that intrinsic value and the option's current value to compute its time value, and that's what we've done here. The option is currently priced at 30.5. Subtracting the 27.7 intrinsic value from it leaves $2.80 in time value. Well, why does it have time value? The option can only go down to 0, but it has unlimited upside. Someone is willing to pay for that unlimited upside over the time until expiration, and they'll pay more if the price has been highly volatile lately. Finally, let's get the number we're going to use to decide whether to close out and redeploy these funds elsewhere, the TVAY, time value annualized yield. This is the time value divided by the collateral. The collateral for covered calls is the current closeout value. That's 97.2 here, which is the strike minus the time value. Another way to think about it is the current price of the stock, 127.7, minus the price of the option, 30.5. That's how much I'd get right now if I closed the option and sold the underlying stock. That's how much we have tied up in this covered call. To convert the yield to an annualized yield, we need to normalize it to 1 year, and that's what we're doing here. 159 is the number of days left, that's less than a year. So we divide the days in a year, 365, by the time left, 159, and then multiply it by the non-normalized yield. This all works out to 6.61%. That's a little above the current short-term rate for treasuries or CDs, so I'm not quite ready to close it yet. If I had some investment I was super excited about, I might consider closing it now and putting these funds to work in that, but I don't. So I'm going to keep waiting and see what happens. If COF stock price rises, its TVAY will drop and I'll close this position out sooner. If COF stock price falls, I'll consider rolling up and out instead. Now on to Roblox, which is an easy decision. I'm just showing the spreadsheet for Roblox, where I make the exact same calculations we just did for Capital One, but I'm computing it for 100 shares instead of just one. My Roblox in the money covered calls intrinsic value is just $92. Its stock price, its current stock price, is 40.92, and that's just a little bit above my strike of 40. Its time value, 566, is significantly more than its intrinsic value. This is unlike COF, which had a time value that was roughly 1/10 of its intrinsic value. And my Roblox call TVAY is very high, almost 38%. So it would be very foolish to close this one out unless I was super bearish on Roblox, which I'm not. I am worried about Roblox's cash burn rate and when it will become profitable. I'm not sure I want a long-term relationship with Roblox just yet. It's more of a short-term fling that I may want to roll up and out at some point, or just let it get called away. And that's a wrap. If you enjoyed this content, please consider liking and subscribing. Also, let me know what you think. I really appreciate any feedback or comments. I'd love to hear how you manage your in-the-money covered calls. I'm not a financial advisor. This wasn't financial advice. This was me sharing my thoughts on when to move on and break up with your high delta in-the-money covered calls. Have a profitable day.